gold is being mobilized as the emerging market currencies collapse. Just like in Turkey and Iran, Venezuela plays the gold card as the carnage with emerging market currencies continues. Here are the details. In recent weeks, global financial markets have been increasingly spooked by an intensifying crisis in emerging market currencies, including those of Turkey and Argentina. Add to this the ongoing currency crisis in Venezuela and the currency problems of Iran. While all of these countries have economy-specific reasons that explain at least some of their currency weakness, there are some common themes such as a stronger U.S. dollar, high domestic inflation rates, economic mismanagement, reliance on foreign borrowing, and in some cases economic sanctions imposed by the U.S. As one currency plummets, this intensifies emerging market risk across the entire asset class, and it is not unreasonable at this time to at least speculate whether the contagion could spread. The Brazilian real and South African rand have come under pressure, and in Asia, the Indonesian rupiah and Indian rupee are also now weakening against the U.S. dollar. It is against this backdrop that physical gold is being increasingly mentioned within these emerging economies, with gold coming to the fore, as it always does in times of crisis. It is for this reason that it's interesting to take a look at a number of these currencies and examine how gold is playing the role of a safe haven for these countries' citizens as well as creating a challenge for these nations' leaders and central banks. Buying up gold as the Turkish lira plunges. With ongoing currency and external debt problems, Turkey, with a population of 90 million, has played a central role in the current currency crisis and remains a catalyst for potential risk contagion across other troubled emerging market currencies. Turkey's currency woes come against a backdrop of a stronger U.S. dollar, domestic inflation of 15%, increasing default risk, market skepticism about the independence of Turkey's monetary policy, and a series of U.S. sanctions against the Turkey economy. Although the Turkish lira was already weakening during the early part of the year, falling 6.4% against the U.S. dollar from January to April, things took a turn for the worse in May, with the lira falling by a further 9% against the dollar during that 1 month. Another 6% drop in the lira followed during July. But it was in August that the Turkish currency crisis really accelerated, with the lira depreciating 28% against the U.S. dollar in an environment of U.S. sanctions and rating agency downgrades of Turkey's debt. During the same time frame, the gold price in Turkish lira rose by approximately 60%, from just under 5,000 per troy ounce at the beginning of January to 7,860 per troy ounce at the end of August. This rising local gold price spurred an increase in physical gold demand in the Turkish gold market, as reported by Bloomberg at the end of May, with a jump in demand for gold coins and Turks buying up gold. As the lira plunges in the latest currency crisis, gold priced in lira is more expensive than ever. That is not deterring buyers who are looking for a safe haven. Turkish people have an interesting behavior. They buy gold when the prices are rising. They think it is gonna rise more, said Gökhan Karakan, who runs a gold exchange office in the heart of Istanbul's Grand Bazaar. People think there is a trend here and choose to buy gold until uncertainty is out of the way. Perversely, in August, while the Turkey lira was in free fall, Turkey's President Erdogan made a nationalistic call for the Turkey public to sell both gold and U.S. dollars and buy Turkish lira. In a speech to a crowd in the Turkish city of Bayburt on the 10th of August, Erdogan advised, "If there is anyone who has dollars or gold under their pillows, they should go exchange it for lira at our banks." This is a national, domestic battle. Although not surprisingly, the presidential bid to support the Turkish lira by selling gold did not work, as the local gold price continued to rise. The lesson from Erdogan's call is clear. Gold is a safe haven and retains its value in times of crisis. Unfortunately, Erdogan's motivations were political, with an irresponsible call to sell one of the only assets that can provide a shelter from the eroding value of the lira. Iran investing in safety as the crisis intensifies. Iran's currency, the rial, has fallen heavily in value against the U.S. dollar this year, losing approximately 60% from an unofficial rate of about 43,000 rial at the beginning of January to 110,000 to the U.S. dollar at the end of August. The currency crisis even led to the head of the Iranian central bank, Valio Yasif, being fired by the Iranian president during July. This slow-motion but steady collapse of the rial had been ongoing for some time due to a weak economy, inflation of more than 19%, and economic uncertainty brought on by the fear of U.S. sanctions, such as in April, but accelerated in May, when the U.S. administration pulled out of a multilateral nuclear deal on Iran and subsequently announced 2 new sets of sanctions against Iran. The first set of these sanctions, which came into effect on the 7th of August, included restrictions on Iran's trade in gold and other precious metals, and on Iran's trade in U.S. dollars. The run-up to the first set of sanctions also saw heightened gold accumulation in Iran. The second set of sanctions, which come into effect on the 4th of November, focus on the Iranian energy and financial sectors, including doing business with the Iranian central bank. Over the year-to-date has the rial slid amidst fear of sanctions, and then the subsequent reality of those sanctions. The Iranian public, Iran population 82 million, rushed to the safe haven of physical gold, hoarding gold coins and gold bars, and pushing demand for physical gold to a 4-year high. As the World Gold Council noted in August, when discussing second quarter Iranian gold demand, faced with renewed economic sanctions and a collapsing currency, which caused a huge rise in the local price of gold, demand for gold jewelry slumped. Instead, demand was channeled into gold investment products, pushing demand for bars and coins to a 4-year high. This was reiterated on the ground in Iran's gold market, as Bloomberg noted at the beginning of August. Demand for physical gold is very high, and has been, as the currency has been weakening, said Masoud Ghalempour, an analyst at Novin Investment Bank in Tehran. People want to invest in something that's safe if they think that a crisis may be on the way. Some of this physical gold demand was met by the Iranian central bank. Triggered by the currency collapse and a rising local gold price, the central bank decided to introduce a gold coin pre-sales scheme designed to dampen down the local gold price, offering 7.6 million gold coins to applicants over time horizons from 1-month to 6-month maturities. For example, the delivery phase of the 6-month maturity pre-sales scheme is active until November. The rial's collapse and eroding value also brought gold to the fore for larger payment transactions in Iran, such as real estate rentals, where, for example, one landlord was asking prospective tenants to pay 2 gold coins to rent a 95-square-meter apartment for 1 month. I know that many may not be able to afford it, but when I see that the currency I may get from my tenants would have less value compared to the previous month, then that leaves me with no choice. If I continued to rent out my apartment in return for rials, then I would face financial loss. Maduro plays the gold card as hyperinflation reigns. In the hyperinflationary economy of Venezuela, where inflation is now running at nearly 65,000% and is predicted by the IMF to reach 1,000,000% before the end of the year, the Venezuelan currency in its various forms continues to hit the headlines. On the 20th of August, Venezuela began the replacement of its existing fiat currency, the Bolivar Fuerte, strong Bolivar, with a new Bolivar Soberano, sovereign Bolivar, at a rate of 1 Bolivar Soberano for every 100,000 Bolivar Fuerte, effectively knocked 5 zeros off the fiat currency. This exercise is ostensibly meant to tackle hyperinflation, but will, like all previous Venezuelan currency experiments, most likely not be effective, and will probably exacerbate hyperinflation. At the same time, the new Bolivar Soberano was decreed to be linked to a murky and opaque state-issued cryptocurrency called the Petro, at a rate of 3,600 Bolivar Soberanos to 1 Petro. This Petro is claimed to be backed by Venezuelan oil, but there is skepticism that the Petro doesn't really exist, or at least doesn't exist, as a functioning currency. All of the above sets the new official rate at 1 USD equals 60 Bolivar Soberano, or 1 USD equals 6 million Bolivar Fuerte, and effectively devalues the Venezuelan currency by 95.8% since the previous official rate was 1 USD greater than 248,000 Bolivar Fuente. The Bolivar Fuente, in its short life, launched in January 2008, itself had experienced many official devaluations against the US dollar, all the while trading on the black market at far lower values and the official rate. Even the new Bolivar Soberano, less than a few weeks old, is already trading at 87 to the USD, far weaker than the official rate. It was into this tumultuous economic environment that Venezuelan President Maduro last week announced a national gold savings plan for workers, retirees, and savings banks, Venezuela population 32 million, that will be launched on the 11th of September. Although the gold savings plan looked half-baked and flawed, as do most of Venezuela's recent forays in economic interventionism, the fact of the matter is that yet again, physical gold makes an appearance in the midst of a currency crisis. Maduro explains his Lingatico gold savings plan at a party conference the 26th of August. Maduro's new plan, known as Lingatico, aims to issue gold-backed certificates backed by small gold bars of 1.5 gram and 2.5 gram weights. The gold will be available for purchase by Venezuelans at 3,780 bolivars for the 1.5 gram gold bars, and the 2.5 gram gold bars will sell for 6,300 bolivars. However, according to Bloomberg, buyers will receive gold certificates, not the actual gold bars. Maduro said that the gold for the saving program is sourced from the eastern Guayana region of Venezuela, not to be confused with the neighboring country of Guyana, which he said the BCV, Venezuela's central bank, had sourced from local gold mines. Interestingly, the gold for the scheme is not being sourced from Venezuela's central bank gold reserves, as they have either been most likely already sold off or under claim in various gold loans/gold swaps. In the two short videos below, in Spanish, Maduro, with small gold bars in hand and sealed packaging with the BCV central bank logo, outlines how the scheme will allow Venezuelans to save in gold and to protect their savings from inflation. The first video was filmed at a Maduro party conference on Sunday the 26th of August. Maduro launches the gold savings plan at Casa de la Moneda in Aragua, Venezuela. The second video, the official launch of the gold savings plan, was filmed at the Casa de la Moneda in Aragua, Venezuela, and again shows Maduro with a gold bar in hand, and ironically is set against a backdrop of huge quantities of Bolivar banknotes, and in the background somewhat bizarrely BCV employees paging through huge quantities of printed banknotes. The contagion spreads. Staying in South America, the emerging market currency crisis has now rippled through to Argentina and to a lesser extent Brazil, with the Argentine peso plummeting in double digits last week against the US dollar on news that the Argentine government had requested an early activation of an IMF loan, fanning market fears that the Argentine economy will have imminent problems repaying foreign-denominated debt. The Argentine peso has lost more than 50% against the US dollar during 2018 and is now 2018's worst-performing currency. The peso's plummet during the week forced the Central Bank of Argentina to hike official interest rates to 60% to try to stop the peso sell-off. And Argentina, where inflation is running at over 25% per annum, now has the embarrassing distinction of having the highest interest rates in the world. Elsewhere in South America, the Brazilian real and Chilean peso have also begun declining notably in value against the US dollar, with the real down more than 20% against the US dollar year-to-date. Further afield, other emerging market currencies are now experiencing possible contagion effects, with the Indonesian rupee now at its lowest level against the US dollar since the Asian crisis of 1998, and the Indian rupee now below 71 to the US dollar. For the first time ever. Expect to see gold linked to currency stories in these economies as the emerging market crisis continues to brew. Physical gold takes center stage in times of crisis precisely because it has tangible value, is not issued by any central bank, monetary authority, or government, cannot be debased, and has no counterparty or default risk. The fact that sophisticated physical gold markets exist in most if not all of the economies currently stricken by currency weakness also allows gold, with its deep liquidity, to be quickly harnessed.